All right, good afternoon, everyone. Good afternoon. All right, let's jump in. We got some earnings names to look at. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure, I got back into small Google. I got back into Baba in the dip. I got back into Reddit, which I closed out of into the close yesterday in front of the report. All right. So where are we here? So first of all, let's see where these earnings names are. Ooh, arm smoked, huh? Reports Q4 EPS is a beat, rev is a beat, guides rev below, the estimate at the midpoint. Guides Q1 EPS above expectations. Guides Q1 rev in line, it seems, in the range. This report doesn't seem too bad to me. Revenue below the estimate at the midpoint, but it's still within the range. This report doesn't seem to be too bad to me, but this is the theme of this market, this earnings season. Yeah, I mentioned it in the morning meeting this morning that saw some statistics that this has been an interesting earnings season. Take a half step back. One thing that we've had a decent amount of success with, and that we've picked up on over the course of the last couple years. Remember us being really accurate with it in this like 2022 bear market to some degree throughout 2023 as well, where we've been anticipating going into earnings season kind of whether or not the market is a little bit expensive or a little bit cheap, technically, fundamentally, and based on that to get an idea of earnings reactions. So what I have tended to see, if that's a word, over the course of my trading career is that if a stock, and in some ways Palantir into this earnings report is like the perfect example of it, we can look at that. If a stock or even the market as a whole catches a really big bid into the earnings report, like the weeks before that or even the month before that or whatever, the stock is appreciated a lot. And then you get like let's just call it, let's keep it simple for the moment. Let's just say it's an inline report, right? So in theory, if everything else was held equal, a report where across the board, and again, let's just try to make this thought process as simple as possible. In theory, a report where across the board every number is a beat on, EPS, revenue, and guidance, everything's a beat, the stock should go up. Where everything is a miss, the stock should go down. And let's say where everything came perfectly in line, a stock should be flat, in theory. In practice, it definitely doesn't work that way. First of all, earnings reports are much more nuanced than that. It's not just about the report and the guidance. It's also about the call and commentary from the CEO and the direction that the company appears to be moving in. So obviously, it gets more complex than that. But generally speaking, that's kind of what you would expect. Yet what I've seen over the course of my career is when stocks have had really big moves into the earning report, big move to the upside into the report, and let's just stick with the inline idea, right? So if we're saying inline means that the stock should be flat, but it went up a lot into the report, and then the company reported in line across the board, meaning that the report is just fine, you'll tend to see the stock sell off. The opposite's also true. Stock gets really beaten up into an earnings report. Market's really beaten up into an earnings report. Earnings come out. It's in line. It's fine. Stocks tend to move up. So, and I don't think we did it as much, honestly, with this earnings season, because it didn't seem like coming into this earnings season where, I know we've caught a bid here back up to $517, but for a lot of this earnings season, we've been sitting around this $500 mark. So we had kind of just entered into like a little bit of a 5% market pullback. So to me, coming into this earnings season, and this is probably why we didn't talk about it as much, the market didn't necessarily seem to be particularly expensive or particularly cheap. Yeah, a lot of individual names you can point to have had really big moves into the market, but there are others that have been a little bit weaker. And again, the market was pretty much, you know, entering this earnings season coming from a 5% pullback. So I don't think we spent as much time talking about this concept, this earnings season coming into it, as much as some previous earnings seasons over the course of the last couple of years, when very clearly we were in the midst of a bigger sell-off or a bigger bull move into the actual earnings season. But what the data has been showing for this earnings season thus far, and if I had to guess, I'd say we're probably like 2/3 of the way through earnings season or so at this point. What the data has been showing so far is that the beats have actually been pretty nice. The amount that companies have been beating by on average is exceeding the historical norm. Yet, companies have actually been selling off much more so on good earnings reports than they typically do. I think the one statistic I saw, and I don't love this statistic because I don't think that seeing last quarter's EPS matters nearly as much as seeing the guidance in the future quarter. Typically, guidance is more important. But one statistic I saw was companies that beat on EPS in their previous quarter, so just EPS, so it's relatively simple. But companies that beat on EPS thus far this quarter, if historically they are up a certain amount, I don't remember what that amount is, in this earnings season, companies that have beat on EPS have been down an average of 1.5%, which is kind of nasty. And again, it's a very simple statistic because it didn't talk about guidance. And I think that guidance beating or missing expectations is significantly more important than what you report for the previous quarter, though they are both important. It's interesting to note, and it confirms, I think, what I have been just seeing with my own trading. Sometimes I can get stuck in my own universe, and I'm not as focused on healthcare names and utility names. Utilities have been trading really well recently, by the way, or staples. I don't focus on those sectors as much because they tend to not be as good of short-term trading vehicles. But that data seems to confirm, at least anecdotally, what I've been seeing. And we got more examples kind of across the board. So first of all, I mentioned Palantir, right? Palantir is kind of being the big example. I thought that Palantir earnings report was just fine. Not, phenomenal, not knock your socks off, but also not terrible. But look what they did into the stock. And this was a particularly unique case because there was I think a Wedbush analyst that came out and was saying positive commentary about that they expect that the earnings report's going to be so good. So they ripped this thing all the way up to 25 and change when it was trading around 22 just for the report to be, again, just fine. And then they bring it all the way back down to, roughly the area in which it was trading. But based on my quick view of this ARM report, that ARM report looks fine. It looks fine. It does not look like a disaster. Also is not, incredible and phenomenal earnings report. But stock's off 9% right now. I would certainly argue that ARM's got a lot of hype around it. Name's a little bit expensive. So of all names, even though this thing is pulled back off highs, this is probably one of those ones that really needed to kind of kill it. But, it's not just there. I mean, my frustration on this Affirm today knows no bounds. I was short Affirm for a few weeks there, kind of managing the position. I was very happy with how I was managing it, but I was out of the money on the position. But I was fine with that just because I wanted to have a short on my books, even if I was out of the money, because I've got 24 longs on right now, basically. But I was like, I can't responsibly hold this into the earnings report against me, even if I'm trying to keep it as a hedge or whatever. Just the way that this thing trades, if it beats, it could squeeze into the low 40s very easily. So I liquidated the position. And then, of course, it, reported what I thought was a really good report. I'm pretty sure Affirm beat across the board. I'm pretty sure. I'm going off memory right now. I don't have the numbers in front of me, but if I remember correctly, they beat on EPS, they beat on Rev, and they guided higher. So, pretty much like a really good report where, again, in a typical earnings season, especially for a stock like this, you would expect that it really takes off. So, my frustration today, and I really am frustrated by it, is not only did I not participate in this nice move lower in this Affirm with the short position that I would have happily continued to manage even through today's high at 38 had it not been off the earnings report. I thought that the earnings report was so good, and the technicals on this thing look so much better now that it got above that like $35 breakout, which again I was upset when that happened when I was short. That I was like, the technicals look great here. Holding above 35, kind of breaking this downward channel that it's been in. $36 looks like a momentum continuation level, and now the earnings report is great across the board. I aggressively bought this one pre-market and at the open. Had that really nice opening pop. I did sell some stock into it, but just with the way that I was trading it and how greedy I was being, I ended up actually losing a decent chunk of money in this thing to the long side, which again, the frustration of that knows no bounds. Even if there's nothing that you can do about it, even if you should not let it affect the way that you trade. I think it's really okay for traders to have emotions about their trading, as long as they don't act on them. that would be the biggest piece of advice that I would give you guys. We're human beings. You're not going to be able to trade and just have zero emotion. The key is to recognize the emotions that you are feeling and experiencing, and just not let them actually influence you. Meaning, and again, what's the best way to not let them influence you? I think we talked about this a good bit at the afternoon meeting 2 days ago. The best way to do that is to have a good game plan for your trading and just follow the game plan. Then it doesn't matter how you feel, upset, angry, elated because the stock's moving in your direction, pissed because it's not doing what it's supposed to, whatever. You just say, fine, I feel a certain way. I'll recognize that I feel a certain way, but regardless of that, I'm going to make sure to, follow my game plan that I have on my trades. And I'll be honest, I didn't do a perfect job on that on Affirm. I was really frustrated by the move and the earnings report and the fact that I wasn't short anymore, and now that I'm long and it's a great report and it won't go up, I was super, super frustrated. And at a certain point, I let it affect me a little bit on how I traded. So I'm, still to this day, 14, 15 years in the business, I am not a perfect trader as much as I strive to be. It's perfection's a goal that I think we should all seek out in trading, but it will really never be attained. The key is to get as close to that as actually possible with your trading. So yeah, definitely was not a perfect trader today, but just want to recognize my frustration, and that at certain points I was doing an okay job. At certain points I've made a couple mistakes, or took some ads that were probably more emotional than actually game plan based, and that's not the right thing to do either. But anyway, I digress. Really, what I'm trying to talk about is this earnings season, because this Affirm's an example of it. It seems like ARM is an example of it. Palantir is an example of it, and the statistics are just showing that we're in an environment here where the market has not been kind to companies as they report earnings, unless, of course, there's something absolutely stellar within that report. It's not to say that companies can't go up. This is not me saying, hey guys, every single time we see a stock gap up in earnings or whatever, we should be selling into that, because that's not true. What was that other one that broke out today on earnings that someone mentioned, I think, in YouTube yesterday afternoon, and then we totally forgot about it this morning? I forget, but it worked great. Toast, yeah, T-O-S-T. We don't want to be just coming in and blindly shorting earnings reports. TOST was a really good looking report, really good technical breakout. I blame myself for not having this on my radar this morning. I was just a little bit behind on my research and just didn't get through every name that I wanted to get through in my research this morning. But this looks like, if you were focused on it this morning and recognized the importance of 25, which we literally talked about in yesterday's afternoon meeting, it worked phenomenally well. Or of course, Apple announcing a $110 billion buyback is another example. Even if it did fade off the 187 opening price, it's not like the stock has gone negative. And if you started shorting it after hours at 179, then you're in trouble. So just something to keep in mind as we're going through this earnings season, even if we are probably about 2/3 of the way through, is that they are generally not really treating a lot of companies kindly in this earnings season. That doesn't mean don't buy them. It just means be cautious, make sure that you're managing your risk. For me personally, I feel like I made a couple mistakes trading a firm today. It cost me some P&L, but I also made a few mistakes trading at one other point in the last week or two. I forget exactly which day it was, and honestly, I forget exactly what I even did. But I remember that I traded something poorly and was buying it on the way down within the last 2 weeks. That means that I've made, two kind of bigger trading mistakes over the course of a couple of weeks now, and that is way too much for me. So I need to recognize for myself, hey, for whatever reason, for my own trading recently, I've been a little bit too fast and loose with certain things, and I probably need to tighten up some things. I've got other trades that have been working out just great, like really, really well, but I don't allow myself to make mistakes with any real frequency. If it happens in a blue moon, fine, it is what it is. Recognize it, don't do it again, and move on. But if I'm finding that I'm making multiple bigger mistakes over the course of a relatively short period of time, that's something that I need to recognize very quickly within my own trading, and that means I need to just tighten things up a little bit. I think I've been a little bit too much of a cowboy in terms of just jumping into a lot of stuff. And even yesterday, though I wouldn't describe it as a mistake, I certainly got myself involved in more fast-moving earnings names yesterday morning than I was able to handle. So it's just becoming kind of a few things in a row here. I don't remember what the name was. I remember I was trading something and making mistakes in it when Peloton was selling off. So that was back here on the 2nd. So that's even closer than I thought. That's not within the last 2 weeks. That was in the last 4-5 trading sessions. So that means that happened pretty recently on May 2nd for me, where I was making some trading mistakes. Yes, that was it. Thanks, Vincent. It was Penn. So whatever, 4 or 5 days ago, I traded very poorly. I made some mistakes. Yesterday, I overextended myself a little bit just with the amount of names. I traded them all correctly, but I just overextended myself with the amount of earnings names that I was in, and I couldn't, properly manage them all at once. Which usually I don't have an issue managing positions until I get towards like 30 positions that I'm in at once and I'm actively trading. That's just for me personally. By the way, if you're a new trader, when I was a new trader, I had a rule that I did not allow myself to be in more than 3 positions at a time, because once I was in more than 3 positions at a time, I would find that I would start to make mistakes and things and I couldn't properly handle it. You fast forward, 14, 15 years, much more experienced. My game plans are just kind of built into my brain at this point. I can handle 20 positions that I'm actively trading and managing without a problem. But now when I get into, the 30 area, I struggle to be able to do it. But not every stock is created the same. Like I'm, trading some Google back and forth. I'm trading some Apple back and forth. But as far as Apple goes, I made three executions in Apple today. Granted, it didn't move a ton, but I just made 3 executions. Whereas in a firm today, it looks like I made about 500 executions. Which makes sense. The earnings day moving really quickly, but yesterday when I'm trading Rivian, I'm trading GoGo, I'm trading Jumai, all as new positions at the same time, managing BYON on earnings. Palantir I was also in. I was trading 5 earnings names at once yesterday morning, in addition to managing another 20 positions or whatever. That just was more than I could handle. And then today, again, in a couple certain spots, I let my emotions get the best of me. I was too heavy and too loose in a firm at some certain points throughout the day. And I paid for it, for sure, a little bit. My worst name of the day. And that was, at one point, very briefly at the open, it was my best name of the day. But I had size in it. So you get that opening move and drop, you're gonna, it's very plausible for that stock to go from best name to worst name on your day real quick. But the point is, and I guess I'm giving myself an afternoon meeting for myself more than I'm giving you guys an afternoon meeting for yourself, but maybe you can take something away from it. In the constant assessment of my own trading, it means that I'm a little bit unhappy with my trading on 3 separate days out of the last 5. That is way, way, way too many for me. So I already wrote it down on a piece of paper here and have it sitting like kind of right on my keyboard, just to tell me to take a half step back on your trading. That doesn't mean don't put on new positions or whatever, but keep in mind that you've got a whole ton of open positions as is that you got to properly manage the game plan on. And there's, no point in coming in and risking large sums of money right now in three new stocks at once that are all reporting on earnings. I'm not doing myself any favors by doing that. So anyway, I guess that covers me. So enough about me. How about you guys? Anyway, let's talk about the market real briefly. The market traded great, which is interesting because we're talking about how there are all these earnings names that are being sold, sometimes on even decent reports, but the market right now is not that way at all. We mentioned that as soon as the SPYs got back above 15, they seem to have fully reproven their innocence, and we were kind of back in full bull on mode. The little asterisk there is that we had gotten above 515 with a pretty decent amount of upside extension. $7 to $9 of extension between the SPYs and the Qs, depending on the moment over the course of the last few days that you are that you're looking at it. But this market held 515 great today, despite there still being $4 worth of extension at 515 off the open. We did say that if you're aggressive, you could try to be buying off 515. For me, I was interested in doing that, but really wanted to save room just in case we got a bigger pullback for a retest of 512 or so, which would not be unhealthy at all. It would just be kind of satisfying the market's extension. But once again, we did a fantastic job just holding in. It's going to allow the ADMA to catch up even more, so we're going to become even less extended. So if you're bullish, I think even 2 days ago, someone in the YouTube channel asked me, as we got above 515 for the first time and closed at 516.61, what do you want to see? And I said the healthiest thing that I would want to see would be more or less sideways action for a few days above 515. That would allow equilibrium to catch up to price. It'd be super bullish, even if it would make for a few boring trading sessions on the index level. But that's exactly just how markets work. Markets work in periods of consolidation and expansion over time, and not every day is a full-on beautiful momentum day. I really liked what Jim was saying in the VTF earlier. I'm not sure if Jim is still here, where he was talking about the way that he likes to trade, and he's got a certain style of momentum trading, and that a big thing for him is that he has to recognize when his style is not what the market is providing on a given trading session, and needs to take a step back on those days. That's like awesome. That's exactly how it needs to be. Not every day is necessarily going to be a 110% beautiful trending momentum day that's full of opportunity. A lot of the times, because again, markets work in periods of expansion and consolidation over time, it's actually more often that you get ranging consolidation type days than you do get the trending type days. So, and I'm just talking from an index level perspective, if you are trading the indexes or whatever your focus is, and it's just not trading within your edge because the market's a little bit extended or whatever, you need to know to be able to take a half step back and trade less, put on less trades, and just be patient to wait for your opportunity to come to you. Because a big mistake that traders can make, and I've seen this happen, is sure, when things line up to their edge, they absolutely crush it. But maybe you're a momentum trader or whatever, and if the market lines up to your momentum edge, you absolutely crush it. But maybe that's 1 day out of 5, and on the other 4 days, you're trying to trade every day as if it's the same. and you end up losing more money on the other 4 than you make when you absolutely crush it because your edge lines up. So, know when to trade, know when to take a half step back. It's a big part of it. It's why I love trading stocks, by the way, as opposed to really being like a futures trader, is because we have so many stocks that you can focus on that'll create opportunity for you, even if the market's in a little bit of a trickier, more range-bound spot. You can focus on earnings names, you can focus on news names, but heck, even being an equity trader, sometimes you're between earnings season and there's just no new news and nothing going on and nothing exciting, and you need to know to be able to take a step back. But the market did a phenomenal job holding 515. They bought up the gap this morning. It's just further confirming that we've kind of gone back into bull territory. I do still want to see the 80 MA on the daily chart catch up to 515 to give me a little more confirmation. I do still want to see the Qs get above 442. It's the one index here that has not been able to recapture this April 15th breakdown high, which has been really important. So I want to see the Qs still do that. And the IWM was relatively weak today, but look where the IWM is trading. We retested this gap fill area, held that as support. ADMA hasn't even caught up yet, but the ADMA is nicely above 200 bucks. So as far as I'm concerned, this market is looking pretty bullish. That's the side of the market that I want to be focused on right now. If we can get any interest rate relief, and I know the TLT sold back down today, or if we can get any relief on this super strong dollar, I do think that as we get through this earnings season, there actually just becomes a higher and higher probability of a market melt up. So we'll see if that happens or not. It's especially true if the VIX stays low. VIX back to 13 bucks right now, so that's going to bring your volatility traders kind of back online and increasing their leverage in the market because they've got a lower VIX. We've seen that the CTAs are buyers in any tape over the course of this week, and the CTAs, in some ways more importantly, over the course of the month, it's much more balanced now than where it was back in March. If you guys remember, in March, and this market uptrend did last for longer than I expected, but guess what? That's exactly what trends do. They tend to last for longer than you expect. If you guys remember what the CTA profile was looking like at the end of March, it was like, yeah, there's going to be a little buying on the way up, and in a flat tape, it is pretty flat, or maybe even a little bit of buying in a flat tape. But it seemed like there was a big downside risk where the CTA selling into a down move would be significantly larger than the CTA buying into an up move. And that was a big thing that we were trying to juggle while recognizing that the trend is your friend and the trend can last for much longer than you expect. Now, when you look at the month out CTA numbers, yes, there is selling into a down tape. Not over the course of next week. Even in a down tape, there's buying over the course of next week. But over the course of next month, they're selling into a down tape, there's buying into an up tape, there's buying into a flat tape, but it seems much more neutral to bullish overall than what we were seeing, honestly, back in March, even as the market was moving higher. So I do think that if these levels continue to hold and we get no disaster from economic numbers over the course of the next week or whatever, which could of course happen, that we just start to have a higher and higher probability of this market melting up, especially as we're starting to hold above these levels. So we'll see if that happens or not, but today was a really good day. For bulls took an early stand. We could have pulled this market back to 512, 513, a couple dollars lower today, but they came in at that 515, which had been that key level, and just took the reins pretty much right away off the open. So it's exactly what you want to see if you're a bull. That's all that I've got. I'm happy to take a look at any questions that you guys have. From Cody, I know overall we were looking for some sort of dip to buy with this gap down. It wasn't enough for me to get in aggressive off the open. I can agree with you on that one, Cody. I usually like to see some selling, then get in long on a signal, but the market got bought up right away and I didn't get any stock. Did you see any setup off the open that was viable? No, not really. Not from my recollection. Just outside of the importance of the fact that we're gapping down to 515. So it was kind of like I said in the morning meeting. Like I think I specifically said in the morning meeting, if you want to be aggressive and that's an important word there. If you want to be aggressive, you could try buying the open versus this 515 area because it's an important level and see if we fill the gap. But I felt it was aggressive because we were $4 extended. $4 extended is not no man's land anymore. $4 extended is an area where I think the risk reward in a bullish market is still to the upside, and that you can buy it. But you still need to recognize that it wouldn't be impossible for this market to have a bigger pullback to somewhere 511 to 513 and still be really healthy, and that would be an even better buying opportunity where you're not being as aggressive because now you've had this bigger dip into this equilibrium area and the pivot is presenting itself in one way or another. So the only thing that I really see for the SPYs today or the market really in general, is if you said, hey, we're bullish right now, we're gapping down, common gaps tend to get filled, and we're gapping down into an important level, and I'm going to buy off that. But again, I do think that would be aggressive. I personally would have liked a bigger dip to be more aggressive. So appreciate the question. Cody from Rex. Today I traded Tesla to the long side. Nice. That would have scared me. I know 170 was important. I traded Tesla to the long side. I was looking for Tesla above 170, which is an important level. Yes, it is. I already know what the daily looks like, but we can take a look. It's a gap fill here. Tesla 170, so some potential support. This morning, Tesla had bad news about U.S. prosecutors are examining whether Tesla committed securities or wire fraud, which led Tesla to having a big gap down to the daily 21 EMA and right at 170. I didn't think the news was actually bad, as it was just an investigation and not actually meaning that Tesla had committed fraud. Okay, so I thought it was a good buying opportunity. In my opinion, I would say that it's an A+ setup, along with the market, which also had a big gap down, which could easily bounce. But it's my first time trading news like this, so I wasn't too sure about it. So I'm going to go a small piece of Tesla right at the open after watching it bounce off 170, but I held the majority of that to 175-ish. The 15-minute EMA caught up. Could you give some feedback? Yeah, for sure. For sure. So I agree with everything that you're saying. You know, the market, the important level, and I even agree with what you're saying on the news as far as them coming out and saying that doesn't actually necessarily mean anything. I would say, though, that securities and wire fraud, even if, you know, it's just an investigation and, you know, they're not found guilty of anything or anything like that, those terms scare the absolute bejeebus out of me. Why is Penn catching a bid? If anyone sees any news on Penn Gaming, I'd appreciate it. Anyway, what was I talking about? Tesla. That news scares the crap out of me because if there is, I mean, the word fraud for me is just an auto avoid for the most part. Some of the biggest, worst sell-offs in the history of the market were caused by that, and I don't think that this would happen with Tesla. I do generally agree with your assessment, but let's say that headline comes out, and then an hour later, they say that, you know, they're guilty of accounting fraud, and I know accounting fraud is not even the word that's used here. Accounting fraud would probably be worse, but whatever. Securities fraud is definitely not good. Wire fraud is definitely not good. What if they halt the stock on you because, you know, all of a sudden there's a deep investigation or whatever? It's not outside the realm of possibility with names generally. So all I'm trying to say is I don't disagree with your thought process at all. And in this individual circumstance, I think it's okay to consider buying that news. I would just say big picture, you got to be really, really careful when the word fraud gets thrown around, because if it is with an equity, it wouldn't be outside the realm of possibility if there was legitimate fraud that was taking place at Tesla, particularly I think if it was at the accounting level, that Tesla gets halted and opens at $20, and you just don't want to be stuck in that. I hope that helps, Rex. But otherwise, I like what you did. Cool. So that is the VTF for now. Some commentary over in the YouTube. I also got some Alibaba today. Thanks for putting it on my radar yesterday. Though Baba felt heavier than JD. Yeah, I just nibbled back into some today. Made a few bucks in it. One of my better names actually. JD's been phenomenal. JD I still have a pretty big position in. Where was your execution in Baba, and where were you risking? Oh, you're asking Gabriel, not me. Okay. Cool. Scrolling through YouTube. Roku did the same as Affirm on its earnings date. Roku had bad language from the CEO on its earnings date, though. So that was one extra piece of information there. Roku initially got bought up after hours. I don't remember exactly what it was, but I remember just reading the commentary and being like, why would the CEO say this? Basically, the numbers are good across the board, and then the CEO came out and said something like, yeah, but we also don't think our business is very good anymore. And then they just wrecked the stock down. It wasn't exactly what I just said, but it was like something along those lines. And that just kind of goes back to what I was saying a little bit earlier about the complexity sometimes of these earnings reports. And, just generally, I would say just looking at, top line beats and misses, while it can be very helpful, and that's the primary mover most of the time for these earnings reports, there's always going to be the individual circumstances where there was some additional language or thought process or whatever that the market liked or didn't like. And with Roku, it was specifically commentary that came out of the CEO, I believe, on the conference call that hit it down. From Gabriel. Nope, you guys are still chatting about Baba, which is great. The TOST looks phenomenal. I'm annoyed at myself for not having this on my radar this morning. Though with that said, I probably have too many names I'm trading right now to begin with. The daily chart here looks really good. Look at this resistance. It's probably what you're talking about with the weekly. Oh yeah, look at that. There's a lot of room for this TOST to run based on this weekly chart if it really starts breaking up, which it is. Cool. All right. Anybody else have anything? All right. So we'll wrap it up there. Have a wonderful night, everybody. See you all tomorrow. And if you're in the YouTube, press the thumbs up button, please. Thank you. Have a nice day.